Tom Lee was literally spot on as usual. Tom Lee said yesterday if June core CPI is below 0.25%, that likely triggers rotations in small caps, industrials, financials, and laggard fangs. In fact, take a look at what's going on today. The Russell is up over 3%. The NASDAQ is down 1.6% today. S&P is down about 1%, and the Dow is up marginally. That is because inflation is falling like a rock, in the terms that Tom Lee and Fundstrat use. The major banks that post their CPI estimates had anywhere from 0.16% on the low side, that was UBS, and on the high side, Morgan Stanley at 0.27%. The average estimate was 0.21%. They were all wrong by a huge margin. June core CPI came in at 0.06% month over month, way below consensus at positive 0.21%. Fundstrat and Tom Lee reiterate inflation is falling like a rock. June core CPI releases AM came in at 0.06% month over month versus consensus of 0.21%. Whoa, inflation is falling like a rock, says Tom Lee and Fundstrat. Fundstrat says in a note out to clients today, quote, as we have written about many times, the lag in the CPI report has been shelter and auto insurance, and both now seem to be cooling. This is why we expect inflation to fall like a rock, because all the other components of CPI are largely back to below pandemic trend. So why is the S&P and the NASDAQ also falling like a rock today, to use Fundstrat and Tom Lee's same analogy? Well, it comes down to your Mag 7. Apple is down 2.5%, Meta's down 3.5%, Amazon down 2.5%, Nvidia is down 4.3%, Google is down 2.66%, and Microsoft is down 2.5% today. You actually have the equal weight S&P that is up over 1% today. And as I previously mentioned, small caps, the Russell 2000, is up over 3%. There's a couple of different things you need to know now. Number one is money has been piling into Mag 7 stocks because it's perceived as safe. It's perceived as safe if the Fed stays higher for longer. It's perceived as safe for profit margins if inflation continues to be high and thus lead the Fed to be higher for longer. It's been deemed the safe trade if we go into a recession. For a lot of these reasons, big tech has been the area that investors have plowed money into. So that's number one. The market cap weighting within the S&P 500 and the NASDAQ are so tilted towards Mag 7. When you see these stocks down anywhere from 2.5% to 4% on any given day, it doesn't matter if the average stock in the S&P 500 is actually up 1%, you're still going to get quite a decline. And then the second thing to consider here is inflation is in fact falling like a rock. That's great in terms of the Fed being able to cut rates, but when inflation falls, especially quickly, it does put pressure on company profit margins. And that's one reason why margins have been so good and profitability has been so good in the S&P 500 for so long. It's because of this high inflation and companies that have had pricing power. So in fact, inflation falling is bad for corporate earnings. It can also be a troubling sign for the economy as well, because inflation and economic activity usually run hand in hand. Most of the time, if you're seeing high inflation, the economy is doing well. And most of the time, if you see low inflation, the economy is not super strong. So to see this rapid fall in inflation, it suggests the economy may be getting a little bit worse at a faster pace than we expect. And it can also suggest that corporate earnings could be under pressure in the coming quarters. Because if you actually annualize this number that we got today, if we got a 0.06% just reading for the next 12 months, you would actually be at 0.72% inflation by the end of 12 months. That's just far too low. But yes, small caps are taking this as really good news because it's all been about the Fed and when the Fed is going to start cutting rates. And in all reality, you've actually already seen small caps get that earnings re-rating as if, small caps are priced as if we're going into a recession already. So the economy's slowing, already priced into small caps. Earnings not being as great, already priced into small caps. So this is just seen as a big win for average stocks. And I've also been calling for this for a while. That is a rotational correction. So from that perspective, this is not as positive for big tech. Overall, though, very positive. Just not positive for the areas that control the broader S&P and the NASDAQ. Basically just your Mag 6. As Fundstrat points out on X, Shelter is finally cooling. Shelter has been running about the same for the past 1, 2, 3, 4, 5, 6 CPI reports at about 0.4% of a monthly increase. Now, this month for June, you only ran at 0.2%. So that is really starting to cool off. And if Shelter starts to get reflected in the CPI data, that much the same way you can see it reflected in something like market rents today, then I would expect inflation to continue to come in very low. As Bespoke writes on X, there's been just one other trading day since 1979 when small cap Russell 2000 rose over 3% while the S&P 500 was down on that day. This was October 10th of 2008. The Russell was up 4.6%. The S&P was down 1.2%. Today, Russell up 3.35%, the S&P is down 0.75%, which really just points out this only really happens at the bottoms of stock market crashes, which can be a sign actually of a potential recovery that could continue for your average stocks. If you extrapolate what happened back here on October of 2008, that was pretty much at the bottom of the markets. They went a little bit lower, but then you've seen everything kind of come back after that. James E. Thorne on X says it's called deflation. No one should be surprised. Ryan Dietrich on X says this bull market is 21 years old. The last bull market died at 21 months, but that was also the shortest bull market in history. Odds favor this bull has a lot longer to go than most expect. It's also being reported today that JP Morgan changes their first Fed rate cut call to September from November. Carl Quintanilla on X, he runs CNBC, one of their longtime hosts, been doing it for 24 years now. Very familiar face if you've watched any CNBC. He says, now the herd is moving in the other direction. And you can now see the odds for a September 18th rate cut by the Fed are sitting at 85.8%. The odds of 2 cuts by September is actually priced higher than no cut at all by September. There's an 8.7% chance of 2 cuts by September, basically a 50 basis point cut in September, and only a 5.4% chance of no cut by September. So you're pricing in either 1 or a double cut by September. And it may actually be positive if you price in a double cut by September, a 50 basis point cut by September, as long as it's for the right reason, as long as the economy holds up. But if we get another inflation report that's like this one, or perhaps in deflation territory, that could theoretically set you up for a 50 basis point cut coming September. Although I don't think that is very likely, it's a possibility the markets may start to consider. Dr. Ed Yardeni says we are raising our year-end target for the S&P 500 to 5,800 from 5,400. He goes on to say we are still targeting 8,000 by the end of the decade. The stock market seems to be discounting our roaring 2020 scenario faster than we expected. And here we have a breakdown of super core inflation, which yes, did come in at the lowest point you have seen since back in 2020. Lower than the end of 2021, lower than basically any other time. And a lot of that was transportation services that absolutely plummeted. That has been very strong, especially in the first part of 2024. Those really high inflation numbers that we got were really from this transportation services number. Recreation services in deep deflation territory, as well as what is this other that is also in deep deflation territory. You can see medical services was really the strong point, as well as other personal services, also a strong point in your super core. But super core coming in at, what is this? Just 0.04%. A very, very low number. David Rosenberg, which has recently been quite bearish on markets, says this on X. The cyclically sensitive CPI deflated 0.4% month over month and has declined now for 4 months in a row. The year-over-year trend in the prices most sensitive to shifts in the economy is now running at negative 1.1% from negative 0.9% in May and positive 2% a year ago. How can Powell not be confident by now? The Fed should get its head out of the sand and either cut rates on July 31st or strongly signal a move is coming on September 18th. And Zero Hedge writes on X, 50 basis point July cut. Ryan Dietrich writes on X, 2 major positive takeaways from this morning. Number 1, inflation is last year's problem, as we've been saying for months. And number 2, claims spiked in early summer like normal with seasonal quirks, happens every year, now calming down. So yeah, this is a pretty Goldilocks scenario. We did have initial jobless claims that came in only at 222,000. We were expecting 236 to 240,000. So even better on the labor market side. At the same time, continuing jobless claims did tick lower as well by about 10,000. I should just go over the numbers as well. Headline inflation month over month came in at negative 0.1%. Last month was 0%. We were expecting positive 0.1%, which is also very impressive considering oil went up like 17% in just the last month. You went from $70 a barrel up to $83 a barrel, and that had no effect on headline or core inflation, which I do find a little surprising. It also looks like the Bank of Japan did step in and try to regulate their currency a bit. That is causing the yen to strengthen a little bit. That is causing the dollar to weaken. Anytime the dollar weakens, that is very good for multinationals. That is very good for small caps, especially small cap multinationals. The dollar is down almost 1% today, and you can see, I mean, when the dollar rises, stocks tend to do poorly. This was 2022. When the dollar falls, stocks tend to do well. This was 2020. The dollar was falling. Dollar rallied in 2022, and markets did not do as well. We do have data coming out tomorrow morning. That is PPI month over month. We can probably expect something like the CPI report we got today. And the estimates are pretty high in that regard. PPI month over month is expected at positive 0.1%. Last month, you came in at negative 0.2%, so another negative number wouldn't surprise me. PPI month over month for your core is expected at 0.2%. Again, a low number. It's not going to surprise me. And then you have Michigan consumer sentiment. We want to pay attention to 1-year, 5-year inflation expectations, as well as Michigan consumer expectations and current conditions. You're expecting things are going to get a little bit better across the board. Markets have been reacting to this survey a lot recently. So the better the economy, the lower the inflation expectations. That's what you need to be watching out for. I'm not going to run through each and every, specific point here, but the headline survey is expected to come in at 68.5. Last month, it was 68.2. We have seen big drops in current conditions and consumer expectations in recent months. We want to see that come back a little bit because right now we're in like recession territory for consumer expectations. And that's been one of the red flags I've been pointing to say, if the consumer feels this bad and they are cutting back this sharply, this is more of a leading indicator than a lagging indicator. This survey is for the month of July. So the month that we're currently in, we're not going to get July data until well into August. So if people are cutting back, don't feel as great, that's not a great sign going ahead. So you want to see these numbers come in as good as possible. That's because, for an example, if you're a multinational company like Tesla, for instance, if you're taking in Chinese currencies, converting those back to dollars, if you're taking in a weak Chinese currency and converting that to dollars, you're going to get less dollars than if you're taking in a strong Chinese currency and converting that back to a weak dollar. And that's the fundamental basis of why the dollar strengthening, going up or going down, is good or bad for markets. Now, on your headline year-over-year inflation number, that came in at 3%. Last month, you were at 3.3%, and you were expecting 3.1%. So positive news there. And again, core month-over-month came in at positive 0.1%. It was really 0.06%. So it was actually under a tenth of 1%. If you were to come in at 0.04%, it would have looked like a 0% month-over-month number. That would have been exceptionally bullish, but this still super, super bullish. We were actually expecting a 0.2% number, and that's what last month came in as. Last month actually came in at 0.16%, so this was a tenth of 1% lower than last month's number. So this is actually 2 months of rapidly decelerating inflation. But then again, I do just want to point out, when inflation comes down and is starting to run at these very low levels, it can put pressure on company earnings. And we actually seen that today in full force with Delta. Airfares are actually down 5% year over year in your CPI report. And that is being reflected in Delta Airlines earnings that reported an 11.9% decline in earnings to $2.36 per share adjusted, which actually missed the FactSet estimate of $2.37 per share. And Delta also missed on guidance. They guided for Q3 earnings between $1.70 to $2 per share compared to $2.03 per share in this same quarter last year. So I think that could be some of the concern, especially in your Mag 7 stocks that are priced for great earnings. The Russell was not priced for great earnings. Just look at the Russell 2000 compared to the NASDAQ or the S&P. That's all you got to look at. You can see expectations are super high for S&P and NASDAQ and very low for the Russell. You're still 15% off of all-time highs for the Russell 2000. David Rosenberg on X, keep in mind he thinks a recession is coming, but I like to share these bearish perspectives as well as the bullish perspectives to stay as neutral as possible. He says the combination of the Atlanta Fed and St. Louis Fed nowcast models are signaling something that is troubling for the macro bulls, that real final demand may well have contracted in Q2. Still don't see a recession in 2024 just because it didn't happen in 2023. Reminds me of what the pundits were saying through all of 1989, 2000, and again in 2007. Bank of America says today's small cap multiples suggest 10% annualized returns over the next 10 years versus 3% annualized returns for large caps, which has been the case all year. Cheap until they aren't. And as Stock Twitch shows from the heat map, and they say on X, a huge sector rotation out of tech and into small caps is happening now. NASDAQ down 1%, IWM up 3.3%. And from the heat map, you can clearly see small and mid caps are catching a bid here, and large caps deep in the red. Even Costco, which is interesting, they announced last night that they actually raised their membership prices for the first time since 2017. Jason Shapiro on X says it's also not a great risk to reward to be short things like this. That is the Russell 2000, especially heading into major data like we got this morning. Evan Gordon says a stunning chart. The current drawdown in CPI used cars and trucks prices is the worst since September of 2009. And as per Bloomberg, America's pandemic savings are now gone, actually negative, about $250 billion. HZ on X, she's been bearish for a while now, says this is the start of something bigger. Peter Burson, that also just called for a recession by the end of this year, if not the beginning of 2025, says inflation is down and the labor market is, quote, stabilizing, except that the unemployment rate almost never goes down and stays down according to history. And here for the S&P 500, 77% of companies are advancing and 18% are declining. Sarah Eisen on X, it takes a quote from I believe this is Pepsi's earnings that says, quote, big corporations making record profits need to do more to lower prices. Part of President Biden's statement on CPI today, Pepsi said it will do that because consumers are pushing back. Quote, the consumer is telling us $5 is as much as they want to pay for a bag of chips. Pepsi also reported sales that disappointed as U.S. consumers cut back on snacks. Maker of Doritos chips and Mountain Dew sodas said Thursday that organic revenue rose 1.9% in the second quarter, missing the 2.9% average estimate of analysts surveyed by Bloomberg. The volume of food products sold in the period was down 2% from a year earlier, including steeper drops for the Frito-Lay and Quaker Foods business in North America. They say, quote, in the U.S., there is clearly a consumer that is more challenged. Chief Executive Officer Raymond LaGuardia said on the company's earnings call. He added that pressures at Frito-Lay are an issue of value, not an issue of anything else, and that weight loss drugs were not having an impact so far. So I also think that's part of what you're seeing today. The early signs from earnings are not great. Again, especially when the expectations are that companies are going to do fantastic. More troubles from the consumers, what we got from Pepsi, and inflation may actually be hurting Delta, which is not a good combination for this earnings season. But again, I just want to point out, it's really affecting the areas where expectations were very high, your Super 6, if you will, that are selling off big time today with super high expectations, whereas again, your Russell did not have super elevated expectations. That is the one that is outperforming, that is seeing the rotation. And again, I've been calling for this rotational correction because as long as the economy stays good, the Fed is looking to cut rates, you should be seeing a broadening out of markets. You should have been seeing this for probably about a month now since we've been expecting that first cut in September. It hasn't happened yet. It's all been big tech seeing the inflows. Now, big tech could see multiple days of outflows or weeks of outflows. That could bring down the S&P and NASDAQ on a headline basis, but prop up the rest of the markets. That would turn this market from a not so healthy market to a very healthy market. And I think you're seeing the start of that today. And again, part of this rally in small caps is also being helped by Japan that intervened in the Forex market. TV Ashi reports citing government sources, a government source or sources. Zero Hedge says this is just the start. Now, it's also interesting that Japan would intervene today, right after the CPI report came out, like literally within minutes. That's actually telling you something massive. We are going to get the first cut from the Fed September, almost guaranteed, because Japan would not intervene in their currency market to stabilize things if we were not expected to cut in September. Why that is because the dollar, the US dollar, has been so strong, pushing down the Japanese yen because of this higher for longer Fed pushing out rate cuts. It wouldn't make sense for Japan to intervene in their currency to stabilize things until we could see the Fed start to cut rates, because the Fed cutting rates is going to weaken the dollar. That's going to help boost the Japanese yen and other world currencies in and of itself. So if you intervene now and you get the first cut coming in September, that's really going to do a lot to boost up the Japanese yen and to stabilize things out. So Japan actually intervening in their currency today is snitching, if you will, that we will get the first cut September. Again, getting the first cut in September, is that good? Is that bad for stocks? The historical precedent is we normally get a decline of over 20% the first time the Fed cuts rates. But as long as earnings do not collapse, which I'm nervous on earnings, I still am very nervous on earnings, especially after the earnings we got this morning with Delta and Pepsi, and the economy holds up, we could be just fine in markets. But again, the historical precedent is you usually do get a steeper decline when the Fed starts to cut rates. Ryan Dietrich points out on X, the S&P is up 3.2% in July so far. The past 10 years, it has been up 3.1% on average. And again, this is the strongest 2-week period of any year, the first half of July. The second half of July is one of the worst periods throughout the year, any year, and August is one of the worst months. So if this does start a broader rotational correction, you do get some more selling, some more fear that maybe comes about in earnings season, that could definitely help set you up for that correction. Bespoke writes on X, days like today happened because of how stretched this spread had gotten, highlighted earlier in the week. Mega caps getting hit hard while small caps are flying. S&P 100 is down 1.5%. Small cap 2000 is small cap Russell 2000 keeps rallying and is up 3.5%. And Kevin Gordon says that's a win. Second consecutive monthly decline for Supercore CPI in June, the largest drop since August of 2021. Bank of America says another month of soft retail spending. Retail sales probably declined in June. The weakness was broad-based. For on StockTwits, sentiment for the S&P, the SPY, the ETF that tracks the S&P is bearish today at 27. Yesterday, it was bearish at 43. Message volume today is high at 72, and the participation ratio is normal at 53. Let's take a look at the triple Qs that are down over 2%. I'm sure the sentiment is pretty dang bad over there as well. Give this a second to load, and you can see sentiment is bearish today at 38. Actually, not as bad as I would think. Yesterday, you were bearish at 41, and message volume today is extremely high at 78. It was high at 60 just one day ago. And if we take a look over here, I want to see what the VIX looks like today. The VIX is only up 3.5% today, which is not nearly as high as I would expect, given the NASDAQ is down 2%, the S&P is down 1%, the Dow actually just went red, and the Russell's holding up its 3% gain. Your treasury yields are declining about 9 basis points, which is not nearly as much as I would expect, given just how good this CPI report actually was. 10-year treasury yields currently sitting at 4.18%. CNN's Fear and Greed Index, after hitting greed of 57 yesterday, is back to neutral at 51, which is actually pretty interesting. If we do see a rotational correction, it may be hard for the Fear and Greed Index to get to fear or extreme fear if we do see the rest of the markets start to participate, but the Mag 7 sell off, the S&P and the NASDAQ could go through a full-blown correction. The rest of the markets could do fine, which can be kind of like the opposite of what we've seen lately. The rest of the market's selling off, and big tech, Mag 6, really carrying the markets higher, and the index just staying in neutral or fear. It may just stay around neutral even if the markets fall. The latest AI investor sentiment survey that came out today shows bullish investors at 49.2%, neutral investors at 29.1%, and bearish investors at 21.7%. So right before today's move, this was calculated yesterday, you actually seen investors get sharply more bullish, about 8% more bullish, and the neutral investors dropped about 3%, bearish investors plummeted almost 6%. And it will be interesting how broader markets trade here, because as I've reported in other videos, the put to call ratio has dropped to the lowest level in about 12 months, meaning you really didn't have many puts on this market at all. And if you are weighted to the S&P and the NASDAQ, you are having a rough day today. What's actually interesting about the option activity today in the S&P 500, you have seen 36 different interesting trades from big money according to Ortex, totaling $3.88 million with a positive order value of 59%. If you take a look at today, you're roughly neutral between calls and puts. About 52% of the activity expiring this Friday is calls, and about 48% is puts. If you take a look at this open interest, though, different story. Open interest on the call side is 25%. Open interest on the put side is about 75%. That means there's about 3 times as many puts compared to calls for this Friday's expiration. Percent of stocks trading above their 50-day moving average is absolutely exploding today. About 11% of all stocks are breaking above their 50-day moving average today, a sign of some much better breadth than what we have been used to recently. Just yesterday, you were trading with about 38% of stocks trading above their 50-day moving average. Actually, that was about 2 days ago, but you went from 38% of stocks above their 50-day moving average, about a third of the markets, to over half of the markets in just 2 days. That's a 24% jump today alone. And Wall Street has totally started to flip their expectations. Live on CNBC today, Lizard's Ron Temple says he's expecting 2 to 3 rate cuts by the end of the year. Take a listen to this.
Post 9 today, Lazard's chief market strategist Ron Temple is back. We're grateful, Ron. Good to see you again. You think September's appropriate? You're not pressing for July? Right?
I think July should be a consideration, but let's be honest, it's not going to happen. I mean, if you look at the markets are pricing a 95% chance now of a September rate cut, up from about 70% yesterday. I think what's going to be important to see on July 31st is how Jay Powell telegraphs the rate cut. I mean, he's already opened the door in his congressional testimony this week, talking about the dual mandate and softening in employment. Now it's really time for the Fed to recalibrate and make sure that they think about both of their mandates, full employment and price stability, not just price stability.
That said, you don't think a cut will necessarily reflect economic weakness, just better trends in inflation, right?
It's primarily, if I could say it's like an 80-20, right? And maybe 80% of it is disinflation. If you look at the last quarter, headline inflation at a 1.1% run rate, core at 2.1%. Some elements of that are not going to be sustained, so I think that's, a bit of a head fake in the positive direction after the first quarter was much worse than expected. The other 20%, though, is there are signs of economic weakening. Look at job creation. First quarter, 267,000 jobs per month. Second quarter, 177. Number of open jobs per unemployed person down from 2 to 1.2. Quit rate down from 3% to 2.2. So there's a lot of data coming in saying there's softening in the economy. Not so extensively that I would say recession's a risk, but that we just go from very strong growth to strong growth.
So could they go in July?
Again, low probability. I mean, if I were sitting on the Fed, I would be advocating for July 31st. Again, they've described their policy as being restrictive, and there's no longer a need to be as restrictive as they are. But I think September is the date when they start. And then maybe the bigger call is, do they cut it each meeting and through year end? I think they do. The market is saying 60 basis points of rate cuts by year end. I think we get 75.
You do. So you see cutting all through the fall?
Yes.
And then what? I mean, what is the path here?
Yeah.
Where are we going?
Well, I'm glad you asked that. That's really important because, again, if I'm right that this is because of disinflation and softening of strong growth but not weak growth, then the case would be that the Fed would cut rates to maybe 3.5% to 4% over the easing cycle, but that's it. So I don't think people in the market should be pinning their hat on a 2.5% Fed funds. And if I'm right, that means the 10-year Treasury yield probably should not go down from here.
And this is kind of the perspective of what you're hearing from all fund managers today. They're all saying September is when the Fed is going to start cutting rates. And as long as the economy is good, that likely just means a broadening out of our markets, a more, participation in our markets, and likely our portfolios will benefit from it. But I do think at the same time, big tech was bid up way too far out of this perceived safety narrative as the only place to be. And we're seeing now that's not the only place to be. And it's putting a lot of big money on notice. And I think this outperformance of the Russell is going to continue for a while. So let me know what you think about this information down below in the comment section. Do you think this selling in big tech continues? Do you think we're due for a bit of a rebound rally? Do you think, again, small caps are going to start outperforming large caps? Let me know what you think down below in the comment section. Hit the like button and subscribe to the channel if you have not done so already. And if you made it to the end of this video, you guys have a fantastic rest of your day, and I will see you in the next one.